I've spent the better part of 2 decades sitting across the table from people who just retired, reading their Medicare letters, their tax returns, their statements. And the thing that quietly costs them the most isn't a bad investment. It's a short list of bills seniors don't have to pay, but keep paying anyway because nobody ever told them the bill was optional. Today I want to show you 5 of them. No sales pitch, just the plain mechanics of how the system works and exactly which bills seniors can stop paying once they know where to look. Some of these are worth a few $100s a year. One is worth over $2,000. By the end, you'll have the program name, the form number where there is one, and the rough dollar value as of 2026, so you can check your own situation tonight. Here's what almost nobody explains. The whole system runs on one quiet default. The bill goes out automatically, but the relief almost never does. Your premium is deducted before you see it. Your surcharge is applied before you can object. But the programs that lower those costs all require you to raise your hand and ask. Take just one program that helps cover Medicare premiums. The government's own estimates show millions who qualify never enroll, not because they were denied, but because they never applied. That's not a personal failing. That's a default that costs you money. Let's fix it. Bill number 1, the Medicare Part A premium. Part A covers hospital stays, and a lot of people brace for a monthly hospital insurance bill that never actually comes. Here's the first thing most people miss. If you or your spouse worked and paid Medicare taxes for at least 40 quarters, 10 years, your Part A premium is 0. Not reduced, free. Most Americans 65 and older pay nothing for Part A, for life. Bill number 2, the Part B premium. As of 2026, the standard amount is $202.90 a month, about $2,400 a year pulled straight out of your Social Security check. Most people think it's fixed for everyone. It isn't. For folks under the income limits, there are programs called Medicare Savings Programs, QMB, SLMB, and QI, that can cover that entire premium. That's over $2,400 a year back in your pocket. And here's the catch that trips everyone up. You apply through your state Medicaid office, not Medicare itself. Bill number 3, federal income tax on your Social Security. For years, the rule was frustrating. Up to 85% of your benefit could be taxed. And that rule still exists. But for tax years 2025 through 2028, there's a new senior deduction, $6,000 per person, 65 and older, $12,000 for a couple. That lowers your taxable income. For many middle-income retirees, that's enough to bring their federal tax bill down to nothing. Be precise, though. It doesn't repeal the tax. It reduces the income the tax is figured on. For some, it lands at 0. For others, just lower. And it phases out above $75,000 single, $150,000 joint. Bill number 4, property taxes. Most states give seniors one of 3 tools, a freeze, an exemption, or a deferral. A freeze locks your assessed value so the bill stops climbing. An exemption knocks a chunk off what's taxable. A deferral lets you postpone payment, often until the home is sold. Depending on your state, that's hundreds to thousands a year, but every one of these is state-specific, and every one requires you to apply. Bill number 5 is the one that ambushes people, the IRMAA surcharge. If your income from 2 years ago crossed a threshold, Medicare adds a surcharge on top of your premiums. Billing today using income you may no longer earn. So the question I get most is, can I reverse it? It depends on why it happened. If a genuine life-changing event cut your income, you retired, your spouse passed away, you stopped working, you file Form SSA 44, and Medicare recalculates on your current income. That can erase it. But a one-time spike with no life event behind it, a home sale, a big Roth conversion, usually doesn't qualify for SSA 44. The good news there, it typically falls off on its own the next year. Everything here is education, not personal advice. I'm not your accountant, and I haven't seen your return. Income limits, state rules, and these tax provisions change, and several of the 2026 numbers I just gave you get reset in future years. Treat this as a map of where to look, then run your own numbers, or sit down with someone who can. So let's sum it up. If you want the short list of bills seniors should stop paying, here are the 5, side by side. Part A, premium, 0 for most. Part B, premium, up to about $2,400 a year covered if you're eligible. Federal tax on Social Security, potentially erased through 2028. Property tax, hundreds to thousands, reduced or paused. And the IRMAA surcharge, reversible with the right form. Notice what they share. The relief was always there. It just never showed up unless someone asked. Let's see an example. Tom and Linda, both 67. Modest pension, a paid-off home. They were paying both Part B premiums in full, paying federal tax on their Social Security, and paying the full property bill. On paper, nothing was wrong. They were simply paying every automatic bill and asking for none of the relief. Map their situation against these 5, and a real chunk of that turns into money they keep every single year. So, when you put it together, this was never really about 5 separate bills. It's about one habit. The system pays out relief only when you ask, and it will never remind you to ask. The retirees who keep the most aren't the ones with the biggest portfolios. They're the ones who learned which bills were optional and raised their hand. Pick the one item on this list that fits you and chase it down this week. If breakdowns like this are useful to you, subscribe. I work through one piece of the retirement system at a time, in plain English, the way I wish someone had done for me before I needed it. And I read the comments, so tell me, of these 5 bills, which one are you going to go check first? I'll meet you down there. And before you go, 2 quick bonus ones I couldn't leave out. First, if you have a Roth IRA, there are no required withdrawals, ever. The government never forces you to drain it on a schedule the way it does a traditional IRA. And that 10% early withdrawal penalty everyone worries about is gone the day you turn 59 and a half. Second, as of 2026, what you pay out of pocket for covered prescription drugs is capped at $2,100 for the year. For someone on a pricey specialty drug, that used to mean thousands more before any relief kicked in. Now, once you hit that ceiling, you pay nothing for covered drugs until January. 2 more bills you may not have to keep paying, and worth checking before you do.